Good morning. Welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts. To taper or not to taper, that is the question. Esther George out this morning saying that, well, basically the Fed needs to start tapering sooner rather than later because inflation and, of course, the supply chain disruptions remain a problem for the economy. Importantly, consumer confidence already under pressure here. James Bullard set to talk a little bit later this morning. Of course, he's been very hawkish. He would want to start tapering next Tuesday if he could and be finished by Friday. So the question here, of course, is how the markets are going to potentially handle a tapering scenario. Now, again, when we start talking about potential for rate hikes and taper, markets don't tend to respond negatively immediately. It takes a little bit of time to set in about what's happening. But again, as we keep talking about this market in general, I want to bring your attention back to the lack of liquidity. The lack of liquidity is the biggest risk for the markets currently. And if there's one thing that you need to be paying attention to more than anything else is what's happening with volume on these buys. As we continue to get the markets going higher, it's happening on lower and lower volume. And that's the real risk here. Again, the differential in liquidity, when we talk about that, is the gap between the buyers and the sellers. Right now, buyers are struggling to find people to sell at these higher prices. The problem is that when everybody wants to start selling, when that time comes and whatever event causes a change in psychology that people want to start selling, buyers live a lot lower in price. But you can see this as well. Every time that we start getting a little bit of selling pressure into the markets, we see a big spike in volume as sellers are exiting the market en masse. Now, we continue to have this underlying bid for the markets, and a lot of this bid for the market here over the last year or so has really been stock buybacks. We're approaching record buybacks for companies. That's been providing a steady bid in the markets, but when markets start to decline, those buybacks will also evaporate. Companies don't want to buy shares back when they're falling in price. So again, there's a lot of things that are going to create an air pocket in the markets at some point. Now again, that's not today. There's no risk of that currently. Right now, we've got a market that's trying to trigger a buy signal here. Money flows are still positive. So again, not surprising that we've had a market just really kind of sustain itself where it is right now. We see this on the NASDAQ as well. If you'll notice here, we have a buy signal on the NASDAQ. The NASDAQ, of course, broke out to a new record here after this recent little sell-off. But again, that same spurt of buying is happening on much lower levels of volume. Now, one thing important here is to pay attention to is that growth stocks respond well to lower interest rates currently. But again, the risk here and what people are gravitating toward is companies that can generate earnings growth in a slowing economic environment. However, we're already at record earnings. We're already at a level where the maximum kind of recovery of earnings is already kind of baked in the cake. So again, a lot of these companies going forward are going to have a lot more difficulty generating what is currently being estimated for earnings going forward. So we're going to start to see two things occur over the next several months, which is going to be a retraction in those earnings estimates. We'll see those estimates come down, and I would suspect rather sharply as the economy begins to slow more, and combine that potentially with tapering from the Fed. This is going to put a lot of pressure on stocks that are potentially very overvalued, and we find a lot of those companies trading at 10, 20, 30 times price to sales in the NASDAQ space. So again, there is risk to markets. Don't discount that. Pay attention to what the Fed's going to be talking about here with taper. But again, the biggest risk I want to keep you focused on here for markets and your money is this lack of liquidity that's happening in this market. Rallies on exceptionally low volume, not a good sign for your money. But again, doesn't mean to be totally risk averse, doesn't mean to be all in cash. Just be aware of the risk. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you tomorrow.